Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's the 24th of October 2023 and here are the questions we'll be answering today. Why didn't India build RapidX under Indian Railways? What challenges will Eastern Freight Corridor face? Should you binge on the rally in media stocks? And what are the different types of EV batteries? Today, we'll talk about two ambitious rail projects which are in the news. One is meant for passengers and the other dedicated to freight. Both the Delhi-Meerut RRTS and Eastern Dedicated Freight Corridor are unrivaled in scale and spectacle. In our first two segments, we dwell in detail into these two projects. Let us start with Delhi-Meerut RRTS corridor, whose priority section was inaugurated by Prime Minister Narendra Modi last week. This is India's first regional rapid transport system. But why wasn't Indian Railways given the responsibility to build it? Tariq Ahmad finds out.
Last week, Prime Minister Narendra Modi inaugurated the first Regional Rapid Transit System or RRTS rail project in India by green signalling the 17-kilometer priority section of Delhi-Meerut corridor. Namo Bharat train service, earlier called RapidX, will be travelling at an average speed of 100 km per hour from Sahibabad to Duhai Depot in Ghaziabad, Uttar Pradesh. The entire Delhi-Meerut RRTS is estimated to cost 30,000 crore rupees and it is expected to be completed in 2025. The semi-high-speed trains have been developed by French rolling stock company Alstom in Savli, Gujarat. The National Capital Region Transport Corporation or NCRTC is the nodal agency for Delhi-Meerut Rapid Rail Transit System. It is one of the 8 such RRTS corridors that the NCRTC has undertaken to connect different parts of Uttar Pradesh, Haryana, and Rajasthan with the NCR. But why is the high-speed rail service not under the Indian Railway? Let's understand from the leader of the Vande Bharat project, Sudhanshu Mani.
Rail projects primarily meant for urban mobility, suburban or commuter services. Keeping them outside the ambit of Indian Railways is not something new. Except Kolkata Metro, all the metros which are coming up or have come up or are going to come up, they are all outside the ambit of Indian Railways. First of all, they are built with funding from central government, state government concerned, and multilateral funding agencies. So that's one reason, because it is focused on the urban mobility related to a city or a larger city area like NCR. It is not a part of Indian Railways because Indian Railways primarily is meant for carrying passengers over long distances or intercity or carrying freight all over the country. So that part is all right. It's been happening and that's the policy.
But these projects still need the approval from the Railways Commissioner of Safety to run.
Metro Act is there. Now there is a Commissioner of Railway Safety. Now there is a standardization and design being in railways. In the system, it has been so built that whatever innovation you do for safety, you first go to railways. Even in conceiving stage, even in the designing stage, even in the implementation stage, you clear your train, and every time you change, you go there. Like it is happening for any train running in railways, and it is being done for metro also. Any project to be opened, there is a huge thing. How many things will be go? Then some agency will do some testing. Then he will go first to electrical inspector to Government of India, who's an independent person, who will see that electrically there is no violation of safety. Then he said, okay, now you go to Commissioner of Railway Safety. Commissioner of Railway Safety is put not under Ministry of Railways, not under UD, but under Ministry of Civil Aviation officer who can not come back, because he should not be, there should be no occasion of pressurizing him to make any compromise.
The regional rapid transit system will have extensive multi-modal integration with suburban railways, metro rail stations, bus services, etc. The Indian Railways continues to be a key stakeholder in all these projects and responsible for safety aspects during their development. Experts say carrying out the urban mobility rapid rail projects outside the purview of Indian Railway accelerates the project implementation. This has been demonstrated by the Delhi Metro and the recent Delhi-Meerut RRTS project.
First of all, this project, unlike other projects like dedicated freight corridor or even high-speed rail between Mumbai and Ahmedabad, and so many other projects, including J&K line, which have been going on for 10, 15, 20 years. This project was, as far as I remember, DPR was sanctioned in 2017 and the work started in 2019. In spite of COVID intervention for 2 years, the progress on this project has been very good.
The RRTS represents a significant leap in environmental sustainability and holds the potential to revolutionize urban transportation with its cutting-edge regional mobility solution comparable to the best in the world. However, its success depends on the convenience and affordability compared to the existing road and rail transport in the region.
And now, in our special segment, we'll explore a massive rail project which is being built as a highway for goods trains. The 1,337 km long Eastern Dedicated Freight Corridor is finally complete. The project, running from Punjab to Bihar, was commissioned in 2006, and after a host of delays and cost escalations, it will be operational from November the 1st. But are there more challenges ahead for this ambitious project? Abhijit Kumar finds out.
During the months when summer scorches North Indian plains and power demand shoots through the roof, most power plants grapple with one thing: coal shortage. Railways, on its part, struggles to supply coal from the mines in Jharkhand and nearby states to plants in north. Freight trains loaded with coal crawls at 20 to 25 km per hour as it shares track with passenger trains which are given priority passage. But all that is set to change. Coal will now reach the power plants of Punjab, Haryana and Uttar Pradesh in half the time. But how? Because the entire stretch of the 1,337 km Eastern Dedicated Freight Corridor or EDFC is ready now. The stretch, which will connect Sahnewal in Punjab to Sonnagar in Bihar, is exclusively made for freight trains which will transport coal, cement, steel and other items. About 17 years ago, in 2006, the then UPA government had approved Dedicated Freight Corridor or DFC along the eastern and western arm of the Golden Quadrilateral. While the Eastern Dedicated Freight Corridor is ready now, the other arm, Western Dedicated Freight Corridor, is also nearing completion. The 1.24 trillion rupees Eastern Corridor will become fully operational from November 1. Originally, the Eastern Corridor was to start from Ludhiana in Punjab and terminate at Dankuni in West Bengal. But the Dedicated Freight Corridor Corporation of India, a subsidiary of Indian Railways which is executing this project, said that it will not construct the 538 km stretch between Sonnagar, Bihar till Dankuni. The Railway Ministry will execute that stretch on its own. Vijay Kumar Dutt, former additional member of Railway Board, tells us why.
If your focus is to move from coal field to north, other commodities, so then the path you choose is which is the most efficient one. And if you see closely from Sonnagar, where it was to terminate, up to Dankuni or beyond, there is a lot of capacity available. The main constraint is our air route, which is this Allahabad route, is oversaturated. even B route is saturated. So in movement of the freight, this is the most critical section. And once you address the most critical section, then you aid and you increase your multiplier factor. So that is what has been done.
A big chunk of the stretch, that was about 80%, was already operational and saw 140 trains running on several sections. The total capacity of the Eastern Corridor is 250 trains every day. It covers the coal and steel belt from eastern India. The Western Corridor of the DFC, connecting Dadri in Uttar Pradesh to Jawaharlal Nehru Port Trust in Navi Mumbai, is also nearing completion. Freight trains will run at 50 to 60 km per hour on the dedicated freight corridors.
We have about 65,000 kilometers of rail and 63 lakh kilometers of road. So 1:100 ratio. While today, even after capacity constraint, 27% of freight is moved by rails. So if you take the ratio, one railway line is equal to 35 expressways. So any capacity addition, and then it is carbon neutral. So any capacity addition in railways will be a gain.
But the road to construction of the dedicated freight corridor has not been without its challenges. Cost overruns have plagued the project since the beginning. The project, funded by the central government, World Bank and Japan International Cooperation Agency, was originally conceptualized at a cost of 28,000 crore rupees in 2006. In 2015, the cabinet approved 81,459 crore rupees for both the corridors. However, the cost of the two corridors has risen to 1.24 trillion rupees. The EDFC project alone has cost 51,000 crore rupees and the revised cost for WDFC was 72,000 crore rupees. The project, slated to be finished by 2017-18, faced a host of issues, including land acquisition, the shifting of utilities like gas pipelines, water supply, sewer lines, etc. While the project is set to take off now, Dedicated Freight Corridor Corporation of India, or DFCC, is staring at yet another challenge. Under the present revenue model between the Ministry and DFCC, the railways pay the public sector undertaking for its services of maintaining and operating freight corridors through a track access charge, or TAC. It is through this revenue, among other allocations from the government, that the corporation undertakes projects and repays its foreign debt. But a GST of 18% is applicable on the TAC, which has essentially increased the outgo from the ministry for the DFCC. And the DFCC may pass on this burden to freight operators. So, is it a cause of worry?
There is a large capacity constraint, and to the extent that even our bulk commodities like coal, cement, ore, we have to move by road, which is much costlier, but there is no option. So once option is created, the GST should not be any hindrance at all, and rather it will help the government in popping up some revenue also.
But some experts disagree.
Profitability again is a misnomer here because if it's only a model where the haulage charges would be paid to DFC and Indian Railways will keep moving goods at whatever tariffs they have today, then while it brings in the benefit of faster movement, it does not bring down the logistics costs.
The dedicated Eastern Corridor, while a visionary project, is indeed facing some challenges. Cost overruns and deadline extensions have already strained the project's finances and impacted its intended benefits. The imposition of an 18% GST may prove to be yet another bump in the ambitious project which intends to speed up goods movement.
Let us now turn our gaze to financial markets. Shares of media companies are on an uprun thanks to a pickup in advertising spending, aided by the ICC World Cup and the coming election season. As stocks remain hot, is it time to binge on the rally? Which stocks find favor with analysts in this space? Harshita Singh finds out in this report.
India is currently leading the charge in the ICC Cricket World Cup, and its winning spree is bringing in record viewership. The recent India vs New Zealand match fetched 4.3 crore viewers, beating the record of the 2022 FIFA finale. The euphoria is not limited to the screens and is visible on the bourses too in the media pocket. The Nifty Media Index has rallied 36% over the last 2 quarters as against a 13% rise in the Nifty benchmark. TV18 Broadcast, Sun TV, Hathway Cable and Dish TV have led the gains, jumping up to 61%. Last year's lower valuations and pickup in advertising spending in the World Cup, which will likely sustain until the national elections, are fueling this rally.
Whenever I pick up the newspapers, I see 6 to 8 pages of advertisement on the front page with all these IPO companies coming up. Then you have state and general elections. There is a whole bunch of movies in the last few months. There was a G20 summit, and then there is the ICC Cricket World Cup, which is currently going on. So all of this has led to ad rates going up in across all the mediums, whether it is print, digital, or whether it is television. As far as the stocks are concerned, sometime last year the valuations have corrected quite a bit, and they were kind of factoring in bankruptcy valuations, whereas their balance sheets were pretty healthy. So the valuations were quite attractive, and I think the growth has come back in. So hopefully the stocks will continue to re-rate for the next 3 to 6 months.
After a muted first half, ad revenues are expected to rise in the second half of FY24 as per Elara Capital. Indian firms, especially in the FMCG and auto space, will aid in 10 to 12% growth in ad spends for 2023 as per industry experts. Besides, the strong comeback of Bollywood films at multiplexes has also lifted sentiment, and related stocks will remain hot, experts say.
Even if I talk about 3Q, the lineup is very healthy with movies like Animal, Tiger 3, Jawan and Dunki. So I think multiplexes should do well from here on, and we like PVR in this space. But in 3Q, with festivities being around, we should see a pickup in ad spends. Within that space, we like Z, given the fact that the hangover with respect to merger with SPNI is now behind. And we should see ad revenues progress in 3Q with festivities being there.
Those at JM Financial expect the strong box office performance to also benefit Z Entertainment and Sun TV. They expect Z Studios, Gadar 2 and Sun Pictures Jailer to help Z and Sun TV report 11% and 47% year-on-year revenue growth respectively in the September quarter. Despite a sharp run-up in the past 6 months, the brokerage still finds value in Sun TV. Gains in Z may pause till the listing of the merged entity, but it is constructive on the stock over the medium term. While Nazara Tech's rich valuation has kept the brokerage cautious. Thus, selective stock picking remains ideal in this space in the medium term. Equity markets are closed today on account of the Dussehra holiday.
He's making plans for an early retirement. Business Standard.
Stocks of companies in the automobile sector are also on a roll. Meanwhile, Japanese automaker Toyota recently said that it would soon start mass producing next-gen solid-state batteries. If successful, Toyota expects its electric cars powered by solid-state batteries to have a range of 1200 km on a charging time of 10 minutes. Raghav Agarwal takes us down the memory lane to talk about the evolution of these batteries. Let's listen in.
Did you know that electric vehicles had shown their mettle way back in 1899? Fueled by lead-acid battery, an electric vehicle named the Never Happy became the first automobile to run at a speed of more than 100 km per hour back then. Invented by French physicist Gaston Plante in 1859, it was the first rechargeable battery. Lead-acid batteries were used as the main energy storage mechanism for electric cars until the 1980s. Now it is used to power the electrical circuit of accessories. After the lead-acid battery, nickel-cadmium and nickel-metal hydride batteries were invented. These offered a lifespan of around 500 to 1000 charging cycles and were easier to carry. In 1991, lithium-ion batteries were first commercialized and have been the mainstay of the EVs since then. In this, electrons are circulated by creating a difference in potential between two electrodes, one negative and the other positive. These batteries, however, pose certain risks. One of the main risks was the swelling of the battery due to the heating of liquid electrolytes. Another risk was the leakage of conductive ionic liquid called the electrolyte out of the battery, either harming the vehicle or triggering fire. Concerns of lithium-ion batteries were addressed in the new semi-solid batteries. Earlier this year, Chinese battery maker Contemporary Amperex Technology Limited or CATL announced a semi-solid lithium iron phosphate EV battery. This battery had an upgraded electrolyte, a separator with a safety coating and temperature regulating algorithms. At room temperature, the company claimed this battery could charge up to 80% in 10 minutes. Moreover, it is capable of driving 400 kilometers on a 10-minute charge. On 20th October, Shenzhen BAK Power Battery Company Limited also announced the launch of a similar battery. With the announcement of Toyota, the world will soon witness a new type of battery, solid-state batteries. These will use a solid electrolyte instead of a liquid one. It will remove the risks of a lithium-ion battery and will be quicker to get charged. Toyota claims that its batteries will provide a range of 1200 kilometers and will be 100% chargeable in less than 10 minutes.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Reports suggest that apart from Toyota, Nissan and Ford are also working on developing their solid-state batteries. Well, that's all for today. For more news, views and insights, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.